This week, we'll try and steal your money.
Look at the last move of central banks. Cut. We are in a massive cutting cycle right here. However,
1 minute Twitter is screaming, 150k Bitcoin now! The next headlines are flashing, 75k is imminent.
This week could be the most dangerous in crypto history. Markets are swinging wildly as the Fed prepares a rate cut, and headlines are sending traders into panic and FOMO. Most will lose money reacting emotionally, but today, you'll learn how to stay calm, think like the 3%, and survive. Why this week could be the most volatile in crypto history. This week marks a critical moment for crypto markets, with extreme volatility on the horizon. Investors and traders are reacting to multiple overlapping events, including regulatory announcements, macroeconomic updates, and global financial trends. Volatility spikes when uncertainty peaks, and right now, headlines are swinging between euphoria and fear. Historical patterns show that weeks surrounding major Federal Reserve decisions or economic reports often produce dramatic price swings. Social media amplifies these effects, spreading rumors, price predictions, and speculative hype instantly. Traders without a clear strategy are reacting emotionally, which fuels rapid price movements. Exchanges and algorithmic trading systems capitalize on these swings, creating amplified liquidity shocks that can trigger cascades of stop-loss orders and margin calls. Understanding why volatility arises helps traders prepare mentally and strategically rather than chasing every headline. The most important takeaway is that these extreme swings are part of the market's natural rhythm, and recognizing them as predictable chaos, not random luck, allows disciplined investors to avoid panic decisions and preserve capital. The Fed rate cut and its confusing market signals. The Federal Reserve's upcoming rate cut has created a storm of conflicting signals for crypto markets. Some traders interpret rate cuts as a trigger for bullish rallies, believing cheaper borrowing costs will flood markets with liquidity. Others fear that rate reductions indicate economic weakness, prompting sell-offs in risk assets. Historically, the S&P 500 reacted roughly 50-50 to past rate cuts, highlighting that short-term outcomes are highly unpredictable. Crypto is closely correlated with traditional markets, so similar uncertainty spreads to Bitcoin, Ethereum, and altcoins. Media outlets and influencers contribute to the confusion, alternating between fear-driven warnings and hyped predictions of massive gains. Retail traders often try to follow these signals blindly, jumping in or out at the wrong moments. The key is to focus on historical context and long-term trends, not headlines. Recognizing that the rate cut itself is not a guaranteed indicator of immediate gains or losses allows traders to avoid emotional reactions and maintain disciplined strategies. How retail traders get trapped by emotional decisions. Retail traders frequently fall victim to emotional decision-making, which is the primary reason many lose money during high volatility periods. FOMO, panic selling, and chasing headlines push traders to enter positions without proper research or strategy. When prices spike, fear of missing out drives impulsive purchases at market peaks. When prices drop, they panic selling locks and losses, often moments before a recovery. Social media and news outlets intensify this effect, constantly broadcasting bullish predictions and bearish warnings. Emotional responses override rational analysis, making traders reactive instead of proactive. Market manipulators exploit these tendencies, creating false breakouts, dumps, and other traps to shake out retail participants. The majority of retail investors lack predefined plans, meaning their actions are driven by short-term sentiment rather than data. The 50-50 reality, short-term market reactions explained. Short-term market movements, especially around high-profile events like rate cuts, are fundamentally unpredictable. Historical data shows that outcomes are roughly 50-50, meaning markets can swing up or down with almost equal probability. For example, analysis of past Federal Reserve rate cuts shows mixed results for stock and crypto correlations. Sometimes a relief rally occurs. Sometimes a sell-the-news reaction dominates. This illustrates that short-term trading is essentially a gamble, with emotional traders disproportionately vulnerable. Volatility spikes occur because traders react to every rumor, headline, or social media prediction, creating noise-driven price swings. Algorithmic trading amplifies this effect, executing large trades based on small triggers and creating cascading volatility. Recognizing that short-term outcomes cannot be reliably predicted allows disciplined traders to focus on long-term fundamentals, macro trends, and strategic planning rather than attempting to chase immediate profits. Common mistakes that make 97% of traders lose. Most traders fail because they make predictable errors during volatile periods. FOMO drives impulsive buying during spikes, while panic triggers selling during temporary drops. Many attempt to follow hype or insider tips without verification, ignoring historical data and long-term trends. Emotional trading replaces rational planning, leading to inconsistent strategies and repeated losses. Another common mistake is neglecting risk management, including stop-loss orders and portfolio diversification, leaving traders exposed to sudden market swings. Overtrading, reacting to every headline, or abandoning predefined plans amplifies losses. Manipulators and whales exploit these tendencies, creating traps designed to shake out retail investors. Security mistakes, like weak passwords or unsecured networks, further increase vulnerability to hacks and scams. In contrast, the successful 3% of traders maintain discipline, stick to their strategy, and focus on long-term growth rather than short-term noise. The psychology of FOMO and panic selling. FOMO and panic selling are two of the most destructive psychological patterns in crypto trading. FOMO pushes traders to chase price spikes without considering valuations or risk, often buying near local peaks. Panic selling occurs when fear dominates reasoning, prompting traders to exit positions during temporary dips or market corrections. Both behaviors are amplified by social media, where bullish hype and bearish predictions spread instantly. Emotional responses override rational analysis, and traders react to perceived trends rather than actual data. These patterns are predictable, and market manipulators exploit them by triggering false breakouts, sudden dumps, or fabricated narratives. Recognizing these behaviors allows traders to pause, assess, and respond logically rather than emotionally. By understanding the psychological triggers that lead to impulsive actions, traders can develop strategies to resist manipulation, maintain composure during volatility, and focus on long-term outcomes instead of short-term fear and greed cycles. Long-term crypto trends that ignore short-term noise. While short-term price swings dominate headlines, the long-term trajectory of crypto is driven by adoption, infrastructure, and technological advancement. Major financial institutions are building on-chain rails, facilitating mass adoption and legitimizing digital assets. Layer 2 solutions, decentralized exchanges, and instant cross-border payments are enhancing usability and efficiency. Stablecoin transaction volumes in 2024 surpassed $27 trillion, proving the ecosystem is operationally significant. Regulatory clarity and increasing public awareness further support growth, making temporary panic or hype irrelevant. Long-term trends are rooted in fundamental demand, improvements, and institutional participation, not in weekly media cycles or market sentiment. Traders who focus solely on short-term price movements often miss the bigger picture, reacting emotionally to events that have minimal impact on the industry's trajectory. By prioritizing structural growth indicators over transient noise, investors can make rational decisions, preserve capital during volatile periods, and position themselves for sustained returns as crypto adoption continues to expand. Protecting your crypto. Security tips and tools. Securing crypto assets is essential, especially during periods of market chaos when scammers and hackers are most active. The first step is implementing strong operational security, including unique passwords, two-factor authentication, and encrypted connections. VPNs, such as NordVPN, hide IP addresses and encrypt data, safeguarding transactions and logins on public or untrusted networks. Cold storage wallets provide additional protection by keeping private keys offline, preventing unauthorized access. Regularly updating software and avoiding phishing links reduces the risk of compromise. Security also extends to verifying exchanges, smart contracts, and third-party services to prevent losses from fraudulent platforms. Trading or storing assets without proper precautions exposes funds to unnecessary risk, particularly when market volatility attracts opportunistic attackers. By combining technical safeguards, disciplined habits, and secure platforms, traders can focus on strategic decision-making instead of worrying about theft or fraud, ensuring their portfolios remain protected through periods of high-risk activity. The Smart 3% Mindset: How to stay calm and stick to your plan. The 3% of traders who consistently succeed share a disciplined, long-term mindset. They enter the market with a predefined strategy, risk management rules, and clear objectives. Unlike emotional traders, they resist impulsive moves driven by FOMO or panic selling. They understand that short-term volatility is noise, focusing instead on structural trends and fundamental developments. During high-risk weeks, they zoom out, evaluating events from a broader perspective and avoiding reactions to media hype or social chatter. The mindset emphasizes patience, research, and strategic planning, not chasing immediate gains. Stop-loss levels, position sizing, and portfolio diversification are implemented proactively. By detaching emotionally from daily price swings and committing to a structured approach, traders preserve capital and maintain confidence. Adopting this disciplined mindset allows individuals to navigate volatile periods with composure, make rational decisions under pressure, and capture opportunities without falling victim to the emotional traps that eliminate the majority of market participants. Remember, short-term chaos is noise. Stick to your plan, focus on the long-term trends, and don't let fear or FOMO control your decisions. Comment below what topics you want next. Trade smart and protect your crypto. Your future self will thank you. Disclaimer: this video is for educational and entertainment purposes only and does not constitute financial advice. Cryptocurrency markets are volatile. Always do your own research and consult with a licensed advisor before investing.